Do a little countdown.
Don't forget
Five,
that.
4, 3,
Welcome to
2. We're
Silvercrest
here
Opportunity
today again
Fund.
on the Mobile Mailbox Money
Passive,
Mastermind.
really I think this massive, stable cash flow, lavish, about the finance for the masses, this 14% in manufactured housing. Really all the deals I've been doing is kind of hard to keep them
Mobile
counting.
Mailbox Money Mastermind here in niche market real estate notes. This morning, we're actually here at the Manufactured Housing Communities of Arizona Conference here at the Wecopa Resort, networking with other private investors, mobile home park owners, and other individuals actually operating in niche market notes in manufactured housing. Today, I have a guest on the channel, Mr. Kevin Shortle, real estate educator extraordinaire, seasoned real estate investor. Met Kevin at a few different conferences, a lot of prolific information that he gives out for free online. So happy to have him here today. I just want to preface, we do have notes immediately available at mobilemailboxmoney.com, providing on average an $80,000 acquisition for $800 or more a month with your first lien collateral. So I'm going to talk about Kevin this morning. We've kind of warmed up to the environment. We'll talk about a little bit about what the market looks like and Kevin's take, into real estate notes. But for those of you that don't know who Mr. Shortle is, I'll let him introduce himself real quick. So Kevin, appreciate having you on the mastermind today and providing us some value. Maybe you could just introduce yourself for the people that don't know you.
Sure. My pleasure of being on, and good to see you gentlemen again from, I guess, Nashville was the last time we saw each other at the convention there. And yeah, I guess you could say I'm one of the OG, as they say today, one of the old guard in the industry. Been around for over 30 years, I think around 33 years in the business. So starting really in the very infancy of the business, way before your cell phones and online websites, internet, way before any of that made this business a lot easier. So we had to do it the hard way, but a lot of times the hard way, you really have to learn the business. We were shuffling around manila folders and looking through all the documents. And if you went to a courthouse back then, you were lucky if it was on microfilm. You had that advantage, and that was about it. And so we really had to learn the details of it, and that's probably one of the reasons why I'm really known for educating people and taking them through a very detailed due diligence process. And as you know, it's so important because we have a great opportunity in the note business, not only in mobile homes, but single family homes, commercial, land. I mean, goes on and on and on. And you have to understand the very fundamentals of what you're buying, because unlike real property, we're buying what's in the four corners of that contract, so you have to understand what they are, what they mean, what your rights and benefits are. So I've been doing this for a long time. Started investing in the business by simply wholesaling notes, which is very simply finding a note, putting it together with a buyer, because I didn't have the capital at the time. And once you started making money and doing your own deals, it became apparent to me that if we were going to expand our business, especially back then, I needed more people finding deals for us. So that's when I got into the education side, where I said, I bet I can train people to do this and motivate them to get out there and meet the so-called mom and pop note owners, bring them our way, let us get those things purchased, and everybody makes money. So it started from that small business and became into a top 5 company really quick. And then the education space is just something really that I've been drawn to and quite frankly pretty darn good at. And I've trained a lot of people. It was so cool at the event we were in Nashville to see new students of mine on panels, older students of mine are vendors there. They have funds, $20 million funds and things like that. Pretty neat to know that I've impacted them in that way and kind of changed the industry in a way, the platforms, trading platforms, all those sorts of things, trained all those guys as well. So really good to see the business in general just grow to where it is, to I think, which is really the pinnacle of all real estate.
I love that. The impact you've had in just a purely a dollar amount sounds like it's pretty big, hundreds of millions of dollars in real estate notes. And coming from a place from a layman, most people don't even know that you can buy a mortgage or you can trade a mortgage or you can borrow against a mortgage, and there's actually a small realm of people that do actually operate in real estate notes, opposed to the mass uh, uh, competitiveness of a traditional real estate investment strategy. The groups are kind of, tight knit, and you've touched it or trained a lot of the people that are actually operating in these strategies. So it's great to see, from someone that may not be a note investor, per se, that them sitting on the sideline right now in 2025 trying to find avenues for return on investment with high volatility in the stock market. And I talked to an investor the other day, and he's having challenge with his multifamily plays. There's real struggle right now, and to have a seasoned educator in front of us right now talking about his hundreds of millions of dollars in impact in niche market notes, and have some of your students out educating and having funds. I love to see it. And I'm relatively newer in the business. We're about 7 years in. But, commend you, got to commend you, buy his book, Real Estate Without Renters. If you're sitting on the sideline, there's maybe an avenue in notes. Kevin, for the investor that's kind of skeptical about the validity in notes, they hear there's problems with regulations. They hear, why they make more money in rentals. What would you have to say to an investor, that's looking into the alternative of niche market notes?
Yeah, Alden, I think it goes even deeper than that. I think it's simply coming out of ignorance, and I don't mean that in a negative way. It just means you're not exposed to notes. You've never heard of it before, and it's new. Everybody can relate to real estate because they've either been a landlord or have been a tenant at some point in time in their lives. So people naturally understand that type of business and understand I could buy property and fix it up and sell it. So I think that comes natural, comes easier to people from real estate. But to your earlier point, the competition there, because so many people think, well, if they can do that, I can do that, I can start going, it is much, much, much more competitive. And the financial side of the business is less understood. Look at it this way. When somebody buys a piece of real estate and they go, most of it's done online today, I understand. But if somebody goes to a title company and they're signing the documents, they're signing document after document after document after document that they have no understanding what is, right? The title company person's kind of rattling off, that's for this, and this tells you that, and this, they're not going through any of that sort of stuff. So the paper that they're signing is actually what we buy. So I think there's a direct, almost ignorance of what it is that they are signing. And the easiest way I can relate that to people is the real estate note business has been around ever since banks started financing the purchase of real estate. That's really all it is. So as long as people have been borrowing money to purchase real estate, that's what a note is. So think of yourselves, everybody. If you own your own home, if you don't own your own home, think of your parents. So you own your own home. You own the home, but you probably borrowed money from a bank. And now maybe you're paying Wells Fargo, or your parents are paying Wells Fargo every single month, right? Do they call Wells Fargo when the roof starts leaking, that sort of stuff? No, Wells Fargo doesn't own the home. You own the home. So you handle all your issues there. The bank is simply what? Collecting that debt every single month. So no tenants, no toilets, none of that sort of stuff in this. And what happens is, visualize it this way. Instead of you making payments to Wells Fargo, I go to Wells Fargo and buy that debt from them. And now you get a letter, and I know you've all received these letters before. You no longer make your payments to Wells Fargo, you now make them here. Well, now that here's me. So now you're making that payment to me. Did it change your monthly payment? No, it just changed where you're sending that payment. Okay, now I use that example really as we don't buy individual notes from banks in that format, okay? But from an understanding standpoint, I think people can identify with that. So we're not buying the real estate itself, it's our collateral, it's our fallback, right? That's what we look at, and we're just buying the debt on the property without all those responsibilities and liabilities. That's what opens up the opportunity. Even if you're a real estate investor and you don't want to leave real estate investing, which is a fine way to make money, you should understand the financial side of it. you're borrowing money all the time. There's going to be opportunities where you can creatively sell real estate, start doing wraps and create mortgages and loans and things like that. And you'll see your profits and your opportunities really start to grow. If you're brand new and you're just looking for alternatives from the stock market that you mentioned, from some of these other alternatives. I talked with a guy earlier today. He's just tired of the rock and roll in crypto. He's like, look, I got to make some money in something safer that doesn't have all these ups and downs. And, once you understand this part of the business, I really think, because I've done money lending, I've bought rental properties, I've done rehab properties, I've wholesaled, I've done money lending, I've done a lot of things in real estate. It always comes back to buying debt on the properties. It's just a much, much easier, safer way to go. We can regulate our risk by how much we pay versus what the property or the collateral is worth. We can measure our discounts so that we can get profitable yields, and we can do it really without spending a ton of money. A lot of people are afraid of even getting in real estate because they don't want to borrow $200,000-$300,000, and go into debt like that. Where else could you invest for as little as 10, 15, 20 grand and make a double-digit return that's backed by something that's worth 3 times what you have in it? So I did a series years ago, and I call it my Notes Versus series, video series. It's probably still around somewhere. Dwayne probably knows where it is. And I took on notes versus real estate, notes versus flipping properties, notes versus the stock market. So I really did an honest comparison to all of them. And I think really, when you understand the notes side of it, I don't think there's any other investment. You got the returns, you got the safety, and the steadiness. And what you'll find is monthly cash flow is going to be much more predictable than the evaluation of what properties are going to be. And that's significant today.
You're banking on the income producing ability opposed to an appreciation speculation. By the time, what's average appreciation nationally? I think it's like 5%. Something to be kind of benchmark about 5%. Your average net operating income of a long-term rental strategy is around 5%, possibly, depending on what market. And you were having challenges at any given time in rental strategies, from unaccounted for maintenance and things of that nature. So you're kind of trying to hit 10%, right? In a long-term rental strategy, speculative of, the data. Where in notes, you can buy an income procuring collateralized asset, earn a double-digit return, and not have to bank on a speculation of income. To me, that really starts to make a what's it called? A scalable opportunity. So say you had $500,000, right? And you are wanting to set up your retirement income and be able to ultimately retire, where there's not all that many options out there right now, especially when you go in depth in the comparisons, of comparable in stocks or whatever it may be, mutual funds, all the above. I'll have to go back and check out that side-by-side comparison and see what that looks like.
Yeah. Let me do this for your listeners and viewers also. Just a real quick case study to kind of summarize what we just talked about.
Yeah, let's see it.
There, and you'll have to allow me to share my screen there. Just sent your request, I think.
So this is a case study, he said, right?
Well, yeah. So I've got 2 deals under contract right now, and this one, a very incomplete PowerPoint, as you can see. I'm just literally just working on this earlier today, but I've got enough here to make for this to make sense. So this is a property outside of Atlanta, Georgia, a little bit more in the suburbs here, and it's worth somewhere between $190,000 and $257,000. Now I'm going to refine that number down to a more definitive number. But at this point in time, again, this is a deal that I have under contract right now, haven't quite closed on yet, but I'm putting together a PowerPoint for it. They only owe $32,400 on this. So huge amount of equity. And I'll just say for easy purposes, we'll just use the lower number and forget about the 250. We'll just say this house is worth 190. Am I safe? if I were to buy this note and it went bad, meaning the person defaults on the payments, am I safe? Of course. Because number one, this property would never go into foreclosure. They would be foolish to let it go into foreclosure. They would either come up with the money or they would what? Sell the property, sell it for $190,000, pay off the 32 grand and walk away, with $160,000, $150,000, whatever. Great. So I'm very, very safe there. But if we took that ultra unrealistic view and said, I'll foreclose on this property, I'd get cashed out at the foreclosure sale anyway, because it would sell for so much money. So on this one, I made an offer on the balance on this is now $32,000, but this will clear it up. So I'm going to buy this note for $28,000. Okay. So my $28,000 is only 15% of what the property is worth. Extreme safety. Okay. The balance on the loan is $32,400. Okay. So I'm buying this at a discount. I'm paying 86% of what the balance is. And what that does for me is create what we call bonus yield. If this loan were to pay off down the road, I'm going to get paid off even more money. So what about return, right? Because everybody's interested. Well, what's my return on this? Well, I'll do the math for you in real time here. I'm paying $28,000 for it. I'm getting 203 payments of $331.72 per month. And that's going to give me a annualized return of 12.5%. Where else can you, honestly, where else can someone invest 28 grand and make a return like that? Now, again, someone could, well, I could put in crypto and double my money. Yeah, you could also lose it all. I could put it in style. I could do options. Yes, you can. You don't have the safety that I'm talking about here. Where can you go and get this kind of return with the safety? Well, you want safety, you can go to a bank and pay, they'll pay a whopping 2%. It's not going to work. And what did I have to do? Did I have to go out and look for 100 notes? Like people go out and look for 100 property. I hear people, it almost sounds like they're bragging. I look at 100 property to identify 10 to get one. I'm like, good God, that sounds like a lot of work. I looked at 2 notes and bought both of them. I've got another one very similar to this one. In fact, the same price. And I'm just working on this one. You can see this PowerPoint's not complete either, but this is the other one I'm buying. It's very, very similar prices. The house is about the same. They owe about the same of money. I'm in the same sort of thing. I've got that for the same exact price, completely different property. And I'll be making the same thing. I didn't have to leave my home. I didn't have to go look at real estate. Didn't have to do any of that. Didn't have to look through a ton of deals to find that. So that's a compelling reason to look at this. And essentially, if you have access to the internet and a computer, you can do this business from anywhere. I've got clients. I've got one guy who lives half the year here, half the year over in Australia. I've got somebody else in England that buys notes over here. So I have people up in Canada. You need a computer and access to the internet.
Not only can you buy notes at mobilemailboxmoney.com, but Kevin, where do you buy your notes from? Where can someone find maybe notes for sale? How does that work?
Yeah, there's a lot of different sources and they use a lot of different methods of selling. There are some that price notes. Sometimes you have to make offers. Sometimes you have to do blind bids. So it's important to know who is providing the inventory, what their rules are as far as how they accept offers and things like that. But there's, the guys from Paper Stack were at the event that we were at, and I trained those guys in the business 12 years ago, and they recognized in our industry, we didn't have a good working trading platform. So you know what they did? They created it. And I just saw today, they have 19,000 registered users.
And that's paperstack.com.
That's paperstack.com. You've got equity firms and things like that, which I probably won't mention, but you've got trading companies that actually trade notes on a regular basis. So inventory is not an issue. One of the things I have to teach people is an efficient manner into which to look at the inventory. You have to filter that inventory down. You could go to just one source like PaperStack, and they probably have 200 notes on there. Well, all 200 notes aren't something you're looking for. You have to refine what it is that you're looking for, how much money you're looking to spend, what your risk tolerance is, what kind of reward you're looking for, what kind of discount you're looking for, and refine that inventory down. And which is a good thing to have, because we do not have the competition that you mentioned earlier that traditional real estate does. Because even though this is a multi-billion-dollar industry, most people are not familiar with it. So we are at a point, which we're going to be at some time, where it would be impossible for everybody who's in this industry to buy every note that was available right now. It's just not going to happen. So when you have that, you have a greater supply than demand, and therefore the prices are extremely good, and that's what you're looking for. On the other hand, if you're looking at real estate, it's a tighter market. It's harder to find these motivated sellers, and you got people competing at auctions, you got people competing at foreclosure sales, and it's just driving your price up and your returns down. And then you compound that with the cost of, we're seeing defaulted loans on short-term loans right now, right? People who do bridge loans and lend money to people to fix up property and resell it. A lot of those flippers are walking now. Why? Because they're starting to run their numbers and going, labor and lumber's more expensive. And the margins that I had in this deal are gone. So why am I doing it? And they're walking away from these loans, which we'll gladly buy, by the way, at a discount, right? We buy non-performing notes as well. So there's different categories of loans. So finding the inventory and access to the inventory is the easy part. You know, it's really the understanding, the knowing the different qualities, coming up with the numbers, and being able to do it that way.
That's having the tools in your tool belt. Ultimately, you know, the proper due diligence processes, right? The due diligence checks to ultimately validate if this is an opportunity or not. Because, you know, you can go to PaperStack, like you said, and see 200 notes and never do a deal. But if you go take an education, you know, and actually get a seasoned veteran's checklist, or, you know, you over a year specialize in niche market notes, you'll end up finding that there's deals out there at the end of the day. And I think a lot of people are kind of stuck in that not so much confidence, but they know about a strategy. You know, I think that maybe that next step is to reach out and get a formal education in notes so you can start to navigate what's going on. What are your top 3 due diligence items looking at notes? You know, there's a longer list than 3, but what are kind of a big 3 that people you know, aren't so much talking about?
Sure. Before I answer that, you know, if you go on my social media, my YouTube channel, anything like that, under my name, you'll see me wearing these hats all the time, right? So I've got a dozen of these type of hats with the clover on it, and the theme is live lucky on these caps. And I learned a long time ago, I wish I remembered from whom, but I don't recall who it was, but it always stuck with me. They said that luck is the intersection of opportunity and preparedness. And opportunities out there all the time. So yes, there are 200 notes on PaperStack right now. There's opportunity, but are you prepared?
Right.
You know, and that is really the critical difference. So if you're prepared, all of a sudden you start to see more opportunity, but the opportunity's been there, you know, all the time. And the next thing you know, yeah, you're getting lucky. But it comes with a lot of preparedness within that. So as a part of that preparedness is thinking in terms of, how do I protect myself, number one, and then maximize my returns, number 2. So we go through that due diligence process, right? And the way I've refined this, which is now practiced by so many of the top people in the industry, is I had to figure out a way that you could be efficient with time. A lot of people, for example, would start, you know, you get an asset list of 10 things, and you go, well, let's start on number 1 and start to detail it out, look at all the stuff. It's very inefficient. So the model that I created became, let me come up with 3 or 4 formulas that I can run. And if that passes my litmus test, I don't know if you remember that from chemistry class, you know, the litmus test, you take the little paper, if it turns, you know, so something really quick that you can determine if the deal is worth looking at anymore. In other words, is this worth more of my time to investigate? So you have to have a real quick test, which are, again, a couple of ratios that we look at that measures risk, reward, and discount. If it passes that test, then we go to the next phase, which is to start to investigate the deal. Now, the way I think it makes the most sense and the way that has worked out very, very successful for all these years is I don't normally go directly to the seller to ask for information. I go online and look at public records because, again, today we have the luxury of, in most every single county, we can look at public documents, which would include deeds and mortgages, liens, other things that might affect our position, property taxes. So I do my own form of title search because my goal is, the way I look at this is, I want to know more about this note than the current note seller does. And a lot of times, quite frankly, I do. And it also educates me to know what questions to ask that seller. So the next phase would be, I'm going to gather the information from the seller to see what they have, compare it to public records. It's always on this trust but verify sort of system. And once it passes that, I have to make sure it's papered up the right way. Because, there's unfortunately times when investors will, not the ones I train because I teach them this way, but they'll buy a note and no problem. The people paid and they go, hey, this is pretty easy. I just went there and decided to buy one and it's working out fine, which is always the case. If you buy a note and the person pays, great, nothing ever goes wrong. What if they stop paying 2, 3, 4, 5, 10 years down the road? And now you have to take some legal action. And then they lawyer up too, and they go, we're going way back here. You didn't do this, you didn't do that. That wasn't recorded the right way. This wasn't done the right way. You're missing this particular document. There was no assignment here. You're missing an allonge on this. And some of those documents you'll never, ever be able to recover. And now you're stuck in a legal battle. You might still win, but it's going to cost you more time and money. So you want to identify any potential problems now, get them corrected. Because I guarantee you this, once you pay for the note, you pay that note seller the money, a couple of months down the road, if something comes up and you go, oh, hey, we're missing a document, we got to get that from them because this came up, their motivation to help you is gone. You want to get the mistakes corrected before you close when they're motivated because you haven't gotten their money yet. So it's a process. So I take a three level due diligence on there, because if it doesn't pass certain things, I don't get to the next level of due diligence. I'm moving on. It's like, I got it. And quite frankly, sometimes that's easy as visual. I'll look at it and look at the property and go, you know what? There's too much inventory. Why am I going to mess with that neighborhood? And that's where the AI comes in too, because now with AI, I can run demographics. I can run all kinds of stuff about neighborhoods and properties and come up with values and come up with all sorts of things instantly, and AI certainly changing, it'll change every industry, but it'll certainly change ours. And that's starting now. I've been teaching, everybody's going to jump on the wagon, but I've been teaching it for a couple of months, already. And I know there's other people that are going to say, hey, he's right. We got to do this. And you'll see more and more about it.
Do you think it could impact the note industry negatively or more positively? Is the income potential of notes affected by artificial intelligence?
Yeah, it's one of those things, any kind of tool is again, there's possibilities of negative impact. There's possibility of positive impact, right? I mean, it can go to the very nature of AI. Are we going to have computers or the machines that are going to kill us, or are we going to do it the smart way? So it starts at a very deep level on that sort of stuff. With the note business, as long as you understand that there still has to be some final checks. I think the people who are going to lose on it is they become over dependent just on AI. What they have to realize is AI will always crank out an answer for you, but what did you really ask it? So when I was teaching in Nashville, I used another case study where I showed them AI liked this deal. When I prompted it, though, it came up with, I think, an $80,000 valuation. And then I prompted it the correct way by saying, I want you to use 3 comparable sales, 3 comparable listings. I want you to, I really outlined what I wanted to do versus the first version of, hey, do a BPO in this property. And it came back 80 grand. When I really fine-tuned it and asked the proper question, it came back at 100 grand. to complete, $20,000 is a big difference in that price range there. And the other thing is, until we have the capability where it can scan and understand the documents, we still have to understand that we're gonna need that as well. For example, in this particular note, which I have I think I got that one here somewhere. Yeah, because I was doing this presentation. Obviously, I'm not going to go through all these slides, but AI loved the note. It even made an offer, so I prompted the right way to tell me what it would bid for the note based upon my parameters. But when I circled back with on everybody, I said, here's the deal though. This loan was modified, and $25,000 of this, sorry, there was a forgiveness on the modification. They put $50,000 of the loan to the back of the loan, modified it so this person could start repaying. So there's a deferred balance, as we call it, of $55,000. But they also put something in here that said, we'll forgive you half of that debt if you make your payments on time through 2022. And then we'll forgive the other half of this $50,000 if you make all your payments through 2023. Now, there's no way, at least right now, that AI would have picked up on that. And that's why AI was making a bid on the total payoff here, okay, which was 163 versus, it really should be $27,000 less than that. And it would have overbid. So you can't, until you learn AI the right way and know how to prompt it, just don't be 100% reliant upon it. Say, I don't need to learn outside of this. AI knows it all, and I can just ask that, and I can do it that way. I don't think you can right now. In the future, who the heck knows? But I still think there's going to be that degree of human involvement for final checking on everything.
I think as the collaborative prompt gets better, as you have your 50-point prompt for ChatGPT of how to evaluate a property properly, and then find those case-specific situations and add that into the prompt, as that goes over the next 5 years, that may be a, tried and true process. So next gen.
Yeah, I think it's going to be, it's going to evolve. I mean, look, like I said, when I first started this business, we didn't even have the internet, So when the internet came around and we didn't have to go physically to the courthouse anymore to find leads, game changer. Then we would still, use the internet and cell phones and share things that way. And then PaperStack comes along with a platform 10 years ago, I guess. They just had their 10th anniversary. So 10 years ago, they come along with this trading platform where buyers and sellers can get together, and contracts can be created. A game changer, so AI is just going to be that next evolution of the business. And we'll have to see how that turns out. But the common denominator is, throughout all of that time, I don't know how many different presidents. So I started at the late stages of the Reagan administration, and then every administration, Republican, Democrat, whatever, all the way through the whole second term of Trump here. Still here, still doing the business, different opportunities. You simply change. The market shouldn't dictate what you're doing. It's the strategies, because back in 2008, 9, 10, wildly different supply of inventory. It was 90% non-performing, 10% performing. Well, today's exact opposite. We've got 90% performing, 10% non-performing notes. So you have to, again, be educated enough to understand the cycles and understand that what worked 10 years ago is not working today. So you have to adapt to the new things that are going on. And AI is going to be another adaptation, I think.
Notes are so nimble, it's important to know, obviously, the ins and outs of how to reperform, what a non-performing is, because no matter who the president is or what kind of, market's going on, there's money to be made in notes at the end of the day. And leveraging AI, if you're not doing that, you're behind the 8 ball at the end of the day, because there's people out here that are, trucking away at the end of the day. Do we have any questions from anyone? I kind of rant. I got plenty more. We'll go through another couple more, but I'm going to open it up just to see if anyone has any questions for Mr. Shortle. So I know that the first half of notes is buying a note, right? Getting the education, buying a note, and collecting your payments, and navigating owning a note. But if you buy enough notes, you end up running out of money and you can't go buy more notes, right? Because, once you end up seeing how much of a golden nugget that income is at the double-digit yield, you end up wanting more. And most people are unaware that they can almost cash out refi on their position, pull all their money out, or most, or some, and still own the note and pledge it as collateral or raise money for more notes. What's your take on that, Mr. Shortle? I'm sure you've done plenty of leveraging and things of that nature. I know that there's a few people on here that do originations and things of that nature. So how would you address that today?
Sure. And the key things are this: you want to tailor it for what's best for you, and what's available in the marketplace. So if you run out of capital to buy notes, well, there's a couple of things you can do. Yes, you can start to partner with people, and you could partner with people where you bring the knowledge, they bring the money. Don't forget, it doesn't have to be that you're contributing money. You can. When I partner with people, I'm also bringing money to the table. I'm in the deal with them. But you could structure deals where, again, you got an investor who's sitting on a bunch of money in an IRA in a cash position because they don't want it in the stock market, or you got somebody who's, got $50,000 in the bank making nothing. And, you bring the deal to the table, you research it, you show the opportunity, you oversee and manage the deal. You can partner in there and not have to put in any money. So there's one way to do it, with or without money. The other way is, yes, you could raise capital. So some people go on to raise a lot of capital and create a fund. But again, a fund's not for everybody. I'm telling you right now. I know a lot of people, they set that goal, and then when they get there, I always go, careful what you wish for, huh? They're like, yeah, it's a lot to it. So that's a big leap. Partnering with people, not a big leap. Putting together a fund, huge leap. The other things that you can do is, yes, you can hypothecate, as we call it, fancy word for just pledge. You pledge your note or your portfolio of notes as collateral for a loan. And the idea there would be low interest rate to borrow, higher interest rate return on the note. You're making the arbitrage in there. It's harder to do today. It used to be banks would do that, but banks now, look, there's no local banks anymore, for all intents and purposes, right? You deal with your local Bank of America. All the decisions are made up in Charlotte, so that's more challenging to do those, possibly with credit unions and local banks that are not, national banks. The other thing would be, which people don't realize, when you own a note, you have an asset. So you have an asset, though. Unlike a house where you sell a house one time, you cashed out. With a note, I could sell portions of my note over and over again. In other words, if I'm entitled to 240 payments and I need to raise some capital, I could go, gee, I wonder what I could sell 40 of the 200 payments for, and run the numbers on that. Or maybe I need more money than that. Okay, maybe I have to sell 100 payments. How much would I get for that? And because we have such a liquid marketplace, you would be able to sell deals like that all day long. And that recapitalizes you, and that's a perfect strategy for somebody who you don't have to do it with IRA, but it could be IRA money that you have. It could be your kids' IRA money, because they don't need the spendable income. But if you buy a whole note, let's say for 50 grand, and you sell half of it for 50 grand, in other words, the same amount of money that you paid for the whole thing, take that 50 grand, buy another note, sell a half of it. Now you're starting to stack all these notes that eventually the payments are either going to come back to you or the loans will be paid off and you're done. For those who I lost on that concept, I'll bring it simple, make it simple. I used this in the class a couple of weeks ago. If you buy a pizza for $18, you got 6 slices on there. Let's say you sell 3 of those slices for $6 a piece. All right. So you got your $18 back, but what do you still have? You still got 3 more slices of pizza. With the note, it works the same way. We bought the whole note for one price. We're just carving off enough slices to get us our capital back to reinvest, but we're still entitled to that back end. Can't do that really with real estate. So that's another technique that gives you that income velocity to build the front and stack the back, as we call it. So yeah, there's a lot of techniques in doing that you can build into it. And that's why, we talk about 10 to 12% returns. And what I mean by that is you can buy notes all day long in that area, in that return right off the shelf, as I like to say, but we can also boost our returns quite significantly by doing some advanced strategies once we own the note. And partials is just one of those. We can do splits. There's all kinds of things that we can do.
So, as a capital raiser and someone who's raised for notes, have you been asked about the securities conversation? Is a note a securities? I get asked that here and there. How would you navigate that conversation?
Well, you ask 10 attorneys, which I have, and you'll get, 5 different opinions. Some say yes, some say no. Would you defend it? Would you put it in writing? No. They're all attorneys don't want to get involved in it. It gets a little bit crazy on that. I haven't seen an attorney come out and say this is that, because they don't want to interpret ultimately what the SEC is going to rule, and so it does get a little interesting on what that full interpretation is. But it also breaks down to some simple concepts. You have some people that say even selling a partial might be securities. And it happens every single day. But they say it might involve securities. And I said, because I've talked with a lot of attorneys about this. I said, okay, where's the cases? Show me a legal case that made a foundation for it. And it doesn't exist, so those opinions and stuff, I don't know. They don't have a good opinion on that. And it's never gone. I've that I'm aware of. I've never seen a case go to court where they said it's a security, but
I've been quoted. I think there was a court case in the late 1930s that the banks actually brought it to the securities exchange, and they ruled that a note, a mortgage on a home, is not a securities instrument. And I wish I had the exact legislature, but they did.
yeah, to break that down to simplicity, when you buy a note, you're buying a note and a security agreement. Only one of those gets recorded. That's the security agreement. Why? Because the security agreement attaches it to the real estate. Why doesn't the note? Because the note's considered personal property. And that's the dynamic that this ruling, I'm sure, was based upon. It's like, if a note's considered personal property, then it can't be a security. But if we get into a thing where, which happened, by the way, when they did the initial Dodd-Frank Act, the first version, it was illegal to sell your own home with financing. I mean, now that went way too far. Now, that was an unintended consequence, but we know that happens all the time. They had to come back and redraw that and say, no, we didn't mean for, certainly if a U.S. citizen owns their own house, they should be able to sell it on terms to somebody. In fact, if you go back historically, that's how real estate was sold. It wasn't sold with a bank. When banks first got into the financing, they required 50% down, and they did 5-year loans. That was it. There was no 30-year loans. I mean, right now there's 50-year loans. I mean, it's crazy. So that's why I think we still have that thing where it's our law is from Old English law, and the notes are not, we're not any kind of security or something like that. It's considered personal. So I would agree. Yes.
I think it's great to identify and interpret single note acquisitions and sales opposed to portfolio note sales.
Mm-hmm.
Maybe you could just touch on those two different identifiers and why those are different.
Sure. The biggest thing for me that I like to convey for people on that is this. If you're buying an individual note, you have really the luxury of doing a full due diligence, seeing all the paperwork, crunching all the numbers, looking at the pay history, looking at all the documentation. You get a full examination without putting up any money, without taking any risk. That's really nice. That's really powerful. So going into a deal to the best of your knowledge, what's likely to happen in the future because you've identified the past. Okay. And your risk and everything else. The switch over to buying in portfolios is you don't have that luxury. When you start buying larger portfolios, you have to move quicker. So again, I'll use the example of somebody who's got a $20 million fund. They raise that capital. They now have to deploy that capital to buy assets. Otherwise, it's sitting making nothing because they have to stay in a cash position to take advantage of a buying opportunity. So while it's sitting on the sidelines, you're losing money for the investors. All right. So you have to then deploy capital. So you have to buy in bigger bulk to get a discount. So now you're looking at buying, let's say, 20 notes in one transaction. You're not going to have the luxury or the time or the staff to go through and research all 20 notes, get BPOs on them, get title reports on them, do the whole thing. You're not going to be able to do that. The seller's going to go, you want this or not? You got to buy in portfolios. And in that portfolio, there's going to be things that are outside of what you really want. But to get the stuff you do want, you got to buy the whole pool. So you're using weighted averages and different calculations. So it switches from individual note mentality to averages on a note. And when you get to the even bigger sales, if somebody's buying from Fannie Mae, they're basically just they're hoping that that there's more winners and stinkers in that portfolio that they're buying there. So with clients of mine who have a large amount of capital, we like to buy portfolios for them because they do want to move some more money, but we want to buy them in a fashion that we do have the ability to go through and do a proper due diligence on each one of them. And there's a fine line, for that. If you're efficient at it, if I was tasked to go through 10 notes and do due diligence, I could get that done in a day. That'd be pretty easy for me. But again, I'm pretty well seasoned. It takes somebody else a little longer to get something like that done. So we try to stay within that realm.
Yeah, so on the securities conversation, participating in a single note, you don't have to be accredited, right? You can buy a note, you can buy a portfolio notes, you could buy 10 notes, and stack those cash flowing assets. But to buy into a portfolio, they would have to invest through a fund, or that individual would have to be some sort of registered entity, and things of that nature. And that just goes into the due diligence of the investor. Really important to identify how you're investing in the note, what your position is that the second lien, first lien. Those are all great topics to discuss here today.
Yeah, the funds that you can invest in, for the most part, yes, you're going to have to be an accredited investor. And they tried crowdfunding platforms and things like that. And the problem is, if you have smaller investors coming in that are not accredited and you're opening it up to everybody on a crowdfunding platform, that hasn't proven to work well in either real estate or real estate notes. There were some big companies in real estate that did that ended up going belly up because the smaller investors, unlike the more capitalized investors, all of a sudden they need your money back or want their money back. And it's like, no, that's not how you agreed to keep your money in. We give you best ability, and it just becomes a mess. And that's why a lot of them just said, no, get rid of that. We're just going with accredited investors. We want fewer investors that have more capital, which makes some sense. But you got to be really careful even with those as well, because you're handing your money over to somebody who's going to manage it. And, as much as I showed you really simple examples here, remember, I'm buying one note at a time. You start buying portfolios, you can make mistakes and you can overplay your hand, and you bought too many stinkers versus winners, and that can really hurt a fund. And all of a sudden the investors aren't getting paid back. And it's still something you really have to look at and examine if you want to be in a fund or not, and look at that management team and what the history is. Yeah.
Well, whether you're raising money, looking for notes for sale, a hedge fund manager, attending these different conferences is extremely important, and that's how me and Mr. Shortle came to know each other. So I was happy to meet you. Go back and view our interview I did with Mr. Shortle at DME, Diversified Mortgage Expo. What other conferences have we attended lately? The SDIRA Summit. We attended the Note Expo. We're here at the Manufactured Housing Communities of Arizona here. So if you're looking for notes, we have a vast deal flow, double-digit yields, and in comparison to residential yields, it's a couple points higher on that rate. So highly competitive out in the market, providing great deal flow. Today's mastermind's brought to you by Silvercrest Opportunity Fund. We're offering a 1-year term to accredited investors at a 10% net, or a 3-year term at 12% net, with a qualified operator, largest dealer of manufactured housing here in Arizona, Win Mobile Homes, Mobile Mailbox Money, and Silvercrest Opportunity Fund. Mr. Shortle, if someone wanted to contact you today, buy your book, get some education, how would they do that today?
Sure, the book's on Amazon. That's pretty easy. So you can find it there under my name or the title, which is Real Estate Without Renters. You could also go to learn.kevinshortle.com and check the spelling there. It's Shortle. It looks like Shortle. So it's learn.kevinshortle.com, and you'll learn more about the programs that I offer, anything from simple education to me personally working with you on every deal and even partnering on deals. So I have a whole wide range of how I work with people. And the way I like to do it is if you reach out to us, you can email me at kevin@kevinshortle.com, and I'll get you hooked up with Dwayne, and he'll get on the phone for up to 30 minutes with you, and we'll just talk and see if this is the right thing for you or not.
Love it. So yeah, again, this is Mobile Mailbox Money Mastermind every 2 weeks at 12 o'clock. It's Pacific time right now here in Arizona. So 12 o'clock every 2 weeks. Every 2 weeks on Thursday at 12 o'clock. So feel free to come back around if you're here today and saw some value. We've had previous hedge fund managers, people that own mortgage conferences, have seasoned investors. Kevin Shortle, real estate note investor, educator extraordinaire. We'll see you guys all in 2 weeks. Kevin will follow up. Hopefully we can do some more collaboration. Just keep growing the opportunity. So we appreciate having each and every one of you here today, and look forward to seeing you in the future or helping you perform outside the stock market with your IRA or personal investment here today. Cash flow in a 30-day program with Mobile Mailbox Money. Everyone have a great week. Thanks, Kevin.
Thanks.